Thank you very much, Tina. Hello, everyone. Welcome to today's segment covering all things policy and regulation. And today we're going to focus on the recent announcement from the FCA prohibiting the sale to retail clients of investment products that reference crypto assets, specifically covering derivatives and ETNs, known as exchange-traded notes. Before we dive into what this means, let me make an introduction to Charles Kerrigan, a partner and global fintech lead at CMS. Good afternoon, Charles.
Hi, Ian. Thanks for having me.
Most welcome. Would you like to give a brief introduction of yourself and what you do at CMS?
Yeah, thanks. So CMS is a big law firm. That means I'm a lawyer, and I'm a fintech and deep technology lawyer. So I work on kind of frontier technology projects in blockchain, artificial intelligence. That takes me into mainstream projects in the conventional financial markets and also into crypto and all of the developing projects that we see going on in that world.
So as we've seen recently, the FCA issued a wholesale prohibition of derivatives and exchange traded notes. And just for our audience, derivatives are products that reference an underlying, so we can have a future or a swap or a forward that references a crypto asset. Whereas an exchange traded note, it operates like a bond, so it basically has a maturity date and is backed by the issuer, so you're exposed to credit risk there, which is slightly different to an ETF, which we don't have any ETFs for crypto yet, but there's a lot of work going on in the US around that. But in regards exchange trade notes, to just quote one that trades on Deutsche Börse's Extra in Frankfurt, there is a regulated BTC, etc., Bitcoin exchange traded crypto ETN on a regulated market that has central clearing. So there are developments in the space, but just really to dive into what this means for the UK, Charles, if you could just generally talk about what this ban is and your sort of sense and your experiences of why this has come from the FCA and now.
Sure. So as you say, the FCA is our regulator in the UK for financial products and activities. And the regulation looks at two things: activities and investments. So what do we mean by that? Activities means things like marketing, selling, investing, and investments, given examples there, derivatives and ETNs are examples, and of course stocks and bonds are examples as well. So the definition of investments is only limited by the ingenuity of market participants. And the regulator's role here is to do a couple of things. Ensure an orderly market would be one. Ensure authorization for market participants. So if you're a business that is entering into activities in relation to investments, and you'd likely need an authorization from the FCA. They take some time and money to get. We might touch on that later. And what the FCA is concerned about here is consumer protection. It also has a remit to ensure that customers are treated fairly and are protected, so not in a position where they could be exposed to unreasonable losses. And that's where this regulation comes from. So the ban on derivatives and ETNs in relation to crypto comes from, I think, fairly clearly consumer protection motivation at the regulator. I think we're going to go on to industry views around it. I think it's worth just noting at this stage that we are broadly consistent with the regulators in the US in this respect. And the FCA isn't saying that it's got a problem with crypto. Its report from earlier this year around summer was pretty positive. So it had done research and noted the fact that adoption in crypto is well up in where it was in the last report, 2018. And I think more notably that users, holders of crypto, are pretty clear that this is a risky investment. So what they didn't find was that there were a lot of people who were investing into this market and thinking that it was a safe market, that they weren't particularly exposed. So we're reflecting here the position of the regulator. It's picking up the pieces. So if this blows up, then the consumers will look to the regulator and say, why were we not protected? That's part of your remit. The politicians will do the same thing. And it's a fast-moving market at the best of times. And I think the FCA is just concerned about the potential exposure that customers have got in this area.
Thank you. Just moving on from that, I noted from the policy release when I read it a couple of weeks ago that 97%, so almost every single response they had, and they had dozens and dozens of industry responses, were against a complete ban. There were a number of suggestions. I was involved in one response where perhaps we could look to other similar areas such as CFDs, where there isn't a complete ban for retail. There's a ceiling for the amount of leverage. Can you give a sense of your experience from clients you've been talking to in the industry at large as to what the view is regarding a wholesale ban?
Yeah, so I'd say the view depends a little bit on how you define the industry that we're talking about here. So if you're thinking about the industry in the broadest terms, financial services, that's a relatively conservative industry. And I think there is a degree of support for the ban, and people in that market probably weren't among the responders. Fintech, there would be more open-mindedness, and crypto for sure. My experience is the same as yours, that these are people who are in the market. From their perspective, these are valuable products that they can use as part of a trading strategy, and therefore there's for sure a degree of disappointment that people wouldn't be able to access those trading products and strategies that they've currently been using. I think also if you look at the industry from the perspective of the providers of the products, then they're going to lose business. So this is something that they've been able to provide to customers. They won't be able to in the future. On the other hand, still within crypto, I think that there is an institutional element to the market that is less focused on derivatives and more focused on adoption. So digital assets and crypto being assets that are more widely traded and part of more conventional trading portfolios. And they're not well represented amongst the respondents, but certainly in my experience, the key from that perspective is not to have this blow up before we've got to full adoption, to try and make this a broad market that has more users rather than a narrow market that focuses on those sophisticated users that want to use these products.
Yeah, that makes sense. And I always think to myself, as a regulator, as you mentioned, your remit is to protect the consumer. And we wouldn't want hundreds of millions of consumer money being wiped away because of the lack of understanding and a lack of knowledge around what is a complex product. And that feeds me nicely into the next question with regards to the reasons that the FCA had given for the ban. And we noted from the policy statement released in mid-October that the main focus was regarding the twin concerns of the volatility of the underlying asset class, Bitcoin, for example, and the valuation of the crypto asset. Can you discuss in slightly more detail around these two aspects, what these risks represent and why the FCA focused specifically on these two?
It's a good question because ironically, we wouldn't normally expect to see a regulator arguing against derivatives. So I think it reveals between the lines an interesting point here. When the FCA looks at derivatives in its general market remits, that's a relatively boring market with CFOs managing their interest rate and foreign currency exposure. So from the regulator's perspective, derivatives are a tool to manage down the risk of volatility. So we're in a parallel world here. How do we find ourselves, as you say, with this feedback from the regulator, which is almost the polar opposite of what you'd expect them to say in a more conventional market? And I think the numbers that we see tell the story of that, that the support for crypto derivatives is particularly underpinned by leverage. So you can use derivatives to achieve two aims. You can hedge away your risk, reduce your risk, or you can magnify your risk by using leverage. And the risk of derivatives in all markets, this isn't just crypto, is that they allow larger trades to be made and therefore the potential for larger losses. And I think that is what the regulator is concerned about, that we're seeing the spot market, the holding of crypto being a relatively smaller market when compared to the potential exposures in the derivatives market. So I think the regulator is putting two and two together there and saying that in this case, derivatives are not being used as a tool to manage risk, they're being used as a tool to magnify risk. And if we put that alongside, there is a perception, although I think maybe you and I would say that that is becoming more out of date, that these are volatile assets at the best of times. So if you're multiplying risk and exposure in relation to already volatile assets, then that is the kind of thing that would concern a regulator.
So that's interesting to hear. And so if I just could come to my final question, if I may, just with regards to what firms and individuals can do. Now, if they believe they understand the risks, as I'm sure many users of crypto right now in the retail space do, what can they do if they still want to use the crypto derivative as a hedge, for example, which is one of the major reasons of having derivatives?
Yeah, sure. So I think it's worth bearing in mind that this is a ban on retail sales. So for a professional investor, if you are characterized as a professional investor, then the ban doesn't apply to you. You're still able to enter into the markets. And I think that is part of the regulator wrestling with this distinction of what is a sophisticated investor for these purposes, because traditionally a professional investor is defined by reference to, they may be a firm, a trading desk at a firm, or they might be someone who is particularly sophisticated, experienced, or just has a level of assets that means that they can be judged to have a level of sort of special knowledge and are less exposed to losing money that they can't afford to lose. So there is still that position there. I think we have still a bit of thinking to do from the regulatory perspective of how do you define a professional investor, because here there are, as you I think reference, some folks out there who are extremely sophisticated and trade high volumes, but not necessarily easy to fit within the traditional category of a professional investor. And I think that's part of where this market is still finding its feet, that the regulators come from quite traditional perspectives. And the crypto assets, I think when we look at it from a broader regulatory perspective, we've got cryptocurrencies on one hand, we've got digital assets on the other hand, and by digital assets there I mean tokenized versions of traditional assets, so a tokenized share, tokenized bond. There's pretty fast adoption coming through in that market, and the regulator's pretty supportive there. So they're making distinctions here all the time that are fine and judgment calls. They do make the point, I've referenced professional investors here in their published rules in this area. They've added an anti-avoidance provision and told market participants not to game the rules. So don't just recharacterize all of your retail investors as professional investors and carry on. So it is going to be tested and checked. I think they're probably also looking from the perspective that we've had some positive stories of large corporates moving some of their cash holdings into Bitcoin in particular. And I think if I were the regulator, I might note the fact that those large sophisticated corporates with deep pockets moving into crypto, but they're just buying the asset. I think they are treating that as risk enough without taking leverage positions in relation to the crypto. So I think it's always the story with these sort of innovations and how regulators face up to them. It's incremental change, and I think here the story of this is the regulator has identified what it thinks is a risk because of the value of derivatives. It's not necessarily a problem with derivatives themselves. So that exposure reflected in the value and volume of the numbers is what's concerning them. As adoption continues, cryptocurrencies become more widely used. We see platforms, the PayPal news is big news in this area. So I think we are moving our way. We might have 2 steps forward and 1 back, but then we'll have another couple of steps forward. So it doesn't change my view in any way of where this market's going.
No, and same here. I totally agree with you. We saw the PayPal announcement the other week, which was positive on the price of Bitcoin, not to mention a number of firms increasing their balance sheet holdings of alternative assets such as Bitcoin. All right, well, I would like to thank you so much, Charles, for joining us today on Coinscrum. If anybody wants to reach out to yourself for any advice on the interesting work you're doing, where can they contact you?
I'm on the CMS website and I'm on LinkedIn, so I shouldn't be hard to find. And very happy to hear from people. We got lots of clients across the firm, UK and Europe, who are crypto businesses and service providers to crypto businesses. We'd love to hear from more. It's something that we've spent a lot of time and effort supporting. So I'm grateful for you to give me the chance to come and talk to you about it.